Welcome you all. Myself Dr. B. Nandini, Assistant Professor and Head Department of Commerce and Finance. In this video, I am going to explain how to prepare the final accounts by the sole trader. Let me know what do you mean by final accounts. The preparation of final accounts includes trading account, profit and loss account and balance sheet. These two statements, trading profit and loss account and balance sheet. The trading profit and loss account shows the profit or loss of the business earned during the year, and the balance sheet shows the financial position of the business. What do you mean by trading account? The trading account shows the trading results of the business. Trading results means the profit arising from the buying and selling of goods. In this trading account, we have to include the expenses which are directly related to purchase of goods. The difference between the purchases and the direct expenses and the sales is the gross profit or loss of the business. I can give the format, that is how to find the cost of goods sold. The cost of goods sold can be found out by adding with the opening stock purchases and add the direct expenses, that is manufacturing expenses, carriage inward, freight, duty, etc. and deducting it from these sales, we have to obtain the cost of goods sold. The preparation of trading account involves the principles of double entry system. Trading account is a ledger account. Therefore, it forms the construction to the rules of double entry principles of debit and credit. Here I can give the format of trading account. In that, first we have to debit the opening stock and purchases. From that purchases, we have to deduct the purchase returns and debit all the direct expenses which are related to purchases. That means, here are the few examples of direct expenses: carriage inward, wages, freight, import duty, gas and fuel, royalty on production, factory expenses. On the credit side of the trading account, we have to show the sales, that is net sales. In order to find out the net sales, we have to deduct the sales return from the sales, and also the closing stock. The closing stock is nothing but the goods which are remain unsold. The difference between the debit side and credit side shows either a gross profit or a gross loss. Next, profit and loss account. The profit and loss account is prepared to know the net profit earned by the businessmen. It commences with the gross profit from the trading account. From the gross profit, the operating expenses and non-operating expenses are deducted, and operating income and non-operating income are added to find the net profit. When the total of all the expenses is more than the gross profit and other income, there remains a deficit, and this is called a net loss. The net profit or the net loss is ultimately transferred to the capital account. It should be added with the capital on the liability side of the balance sheet. This is the format of profit and loss account. First, we have the heading as profit and loss account of the name of the concern for the year ended. For the period, we have to write that which we are going to prepare the profit and loss account. We have to mention it. And on the debit side of the profit and loss account, first write gross loss. If it is a gross loss, you write it as a gross loss. Or if it is a profit, means on the credit side of the profit and loss account, we write it as by gross profit. Then in the debit side of the profit and loss account, first we have to write the expenses which are related to the management, that is management expenses, and from the management expenses we have to write the financial expenses, and next selling and distribution expenses, and the depreciation and maintenance expenses. These are all the expenses, either it may be a operating expense or a non-operating expense. Then on the credit side of the profit and loss account, we have to write the incomes which are relevant to the business. The few of the examples are interest received, discount received, commission received, rent from tenant, income from investments, interest on debentures, and miscellaneous revenue receipts. The difference between the expenses and the gross profit and income is either a net profit or a net loss. And the net loss or a net profit can be carried forward to the capital account on the liability side of the balance sheet. Next, what do you mean by balance sheet? Balance sheet is nothing but it's a statement which shows the financial position of the business. It has two sides, that is liability side and asset side. On the liability side of the balance sheet, we shows the capital and what are the liabilities due by the business. On the asset side of the balance sheet, we have to show the assets which are owned by the business. Here I can give the format of preparing balance sheet. For that, first we have to give the title as balance sheet of a company or a sole trader, that is the name of the business as on the date. On the liability side of the balance sheet, first we have to write the capital. With that capital, we have to add the net profit. If it is a loss, means deduct the net loss from the capital and add the additional capital any made by the businessman during the year, and interest on capital if any is provided by the business. You have to add this one with the capital and deduct the drawings and interest on drawings if any. And after that, we have to write the long-term liabilities. The long-term liabilities means the liabilities which can be payable after a period of 1 year. That is more than a period of 1 year. In that long-term liabilities, we have to write the bank loan, and next we have to write the current liabilities. Current liabilities means the liabilities which can be payable within a year. Few examples of current liabilities are sundry creditors, bills payable, bank overdraft, outstanding expenses, and income received in advance. On the asset side of the balance sheet, first we have to write the fixed assets one by one, and next we have to write the current assets. Current assets means the assets which are easily converted into cash. Under the current assets, we have to write we have to show the cash in hand, cash at bank, sundry debtors, bills receivable, closing stock, prepaid expenses, accrued income, and next to that current assets, we have to write the fictitious assets. The fictitious assets are those assets which are imaginary, which cannot be seen. The examples are preliminary expenses, advertising expenses, underwriting commission, discount on issue of shares, and discount on issue of debentures. Finally, the total of the balance sheet must be agreed. That is, the total of the liability side is equal to the total of the assets. Next, adjustment entries. Adjustment entry is nothing but it is made at the end of the year. It is not included in the journal, ledger, and in the and ultimately it cannot be included in the trial balance. Hence, it is always given on the outside of the trial balance. While preparing the final accounts, these items are always given on the outside of the trial balance. It means that it is not For that entry, there is no journal is provided. Hence, it is not included under the ledger and it is not shown on the trial balance. So, the adjustment entries are taken into account while preparing the final accounts of the sole trader to know the real profit and the true financial affairs of the business. It is always given outside the trial balance. So, we have to make a entry for this one just like a journal, that is for debit and credit is given for these items. First item, closing stock. So, closing stock is an item which is valued at the end of the year. Closing stock means it is a goods which are unsold lying under the accounting period. It should be valued either at cost price or market price, whichever is lower. The value of closing stock is shown on the asset side of the balance sheet. The adjustment entry for the closing stock is closing stock account data to trading account. That means we have to show the closing stock on the trading account credit side and in the balance sheet asset side. The next adjustment entry is provision for discount on creditors. The creditors may offer some discount for prompt payment by the firm. This is calculated at a certain percentage on sundry creditors. The adjustment entry is provision for discount on creditors account data to profit and loss account. It will be shown on the liability side of the balance sheet and in the profit and loss account credit side. Next, outstanding expenses. This means that there are certain expenses which are unpaid at the end of the financial year. It also taken into account while preparing the balance sheet and the trading profit and loss account to know about the true profit and true financial positions. It will be given outside the trial balance because it is not yet paid. If it is paid means we have to pass the journal entry and it is included in the journal and it is given in the trial balance. So, outstanding expenses means it is not paid at the time of preparing the final accounts. So, we have to add the expense with the particular expenses. Either it is related to the trading account expense or it is related to the profit and loss account expense. We have to add with the concerned expense and shown on the liability side of the balance sheet because it is a liability to the business. Next, prepaid expenses. The prepaid expenses are nothing but the expenses are paid in advance. It is not relevant to the current year for which we are preparing the accounts. Hence, we have to make an adjustment for this one. If the prepaid expenses are given in the problem means we have to deduct it from the respective expense. Either it may be a trading account relevant expense or it may be a profit and loss account relevant expense. Whatever may be the one, we have to deduct it from the respective expense and shown on the asset side of the balance sheet. The adjustment entry is prepaid expenses account data to expenses account. Next one is accrued income. Accrued income means the income are earned but we are not yet received on the date of preparing the accounts. So, these are taken into account while preparing the final accounts. The accrued income are shown on the asset side of the balance sheet and add with the concerned income. The journal entry is accrued income account data to income account. Next item is income received in advance. So, when the trader receives money in advance during a particular trading period for the work to be done in future period, that means that the trader received the amount in advance before doing the work. That is called as income received in advance. Such income is shown on the liability side of the balance sheet and deducted from the concerned income. The journal entry is income account debtor to income received in advance account. It always appears on the outside of the trial balance. Next one is depreciation of an asset. Depreciation of an asset is nothing but decrease in value of asset due to the continuous use of the asset. It is shown on the profit and loss account debit side and on the balance sheet deducted from the concerned asset account. The journal entry for this one is depreciation account debtor to asset account. Next item, interest on capital. Interest on capital is nothing but the capital contributed by the owner. For that, the interest is paid by the business. It is shown on the profit and loss account debit side and on the liability side, it will be added with the capital. The journal entry for this one is interest on capital account debtor to capital account. Next adjustment item is interest on drawings. So interest on drawings is nothing but the interest is charged by the business on the drawings made by the owner. It is always given on the outside of the trial balance. It is credited, it is an income to the business, hence it is credited on the profit and loss account and it is shown on the liability side of the balance sheet. On the balance sheet, from the capital, we have to deduct the interest on drawings along with the drawings because it reduces the amount of capital contributed by the businessmen. The journal entry is capital account debtor to interest on drawings account. The next adjustment item is bad debts. Bad debts is nothing but it's a loss arising on account of credit sales. The amount which could not be recovered from the debtors is called the bad debts. It is shown on the debit side of the profit and loss account and on the balance sheet's asset side we have to deduct it from the debtors. The journal entry is bad debts account debtor to debtors account. The next adjustment item is provision for discount on debtors. It's nothing but while paying the amount by the debtors, the discount is allowed or given by the businessmen to make the payment promptly. For that, the provision is made by the businessmen. So, it is an expense to the businessmen. Hence, it is debited to the profit and loss account and deducted from the debtors on the asset side of the balance sheet. The journal entry for this one is profit and loss account debtor to provision for discount on debtors account. Next, provision for discount on creditors. The creditors may offer discount to the creditors for prompt payment. So, it is calculated at a percentage on the sundry creditors. It is a income to the business. Hence, it is shown on the credit side of the profit and loss account and deducted from the sundry creditors on the liability side of the balance sheet because this will reduce the amount of payment due to the creditors. The journal entry is provision for discount on creditors account debtor to profit and loss account. Then loss of stock by fire and accident. Sometimes the goods which are kept in the godown are lost by fire or either by theft. It is a loss to the business and it is insured also. If it is insured means the amount can be recovered from the insurance company. So, the amount which is recovered from the insurance company is a gain and what is the actual loss on account of loss of stock by theft can be shown on the profit and loss account debit side and the amount recovered from the insurance company is shown on the asset side of the balance sheet. Thank you.